in the past quarter was that it was challenging. The third quarter of this year really was much more analogous to 2022 than it was the first half of 2023. The momentum that began in Q1 and Q2 of this year really halted, leaving very few places to find cover in this last 3 months. Market forces continue to influence stock prices. Higher interest rates for longer is really the theme that's going on through global markets. Lingering elevated inflation is impacting both consumers and companies alike. We're seeing a strong dollar also impact company health and performance. In the third quarter, it was notable that the energy sector had a real strong surge. It was kind of the only positive area of the marketplace. And unusually, utilities, which was historically a fairly flight to safety type area, struggled badly in the third quarter. We also saw a rotation into more value-oriented areas of the marketplaces. Input costs have gone up for companies with this energy price spike. IT spend by companies has continued to be depressed coming out of 2022. Businesses are really only spending on technologies that will help efficiency or cut costs. They're not really spending money on technologies that will further grow their businesses. We're also seeing continued China weakness. The Chinese consumer is on uneven footing right now, as well as the fact that there is some concern about the health and longevity of the real estate market. And of course, we have geopolitics and unrest throughout the world, specifically as it relates to the ongoing war in Ukraine from the invasion by Russia, and even the US contributing to some unease this quarter as we approached our debt ceiling. We did manage to kick that can down the road, but it's only a stopgap measure, and we'll likely be talking about it next quarter. Yeah, our performance in the quarter was challenging. We underperformed the index in the third quarter. We continue to be ahead of that index year to date. In the 3-month period, we did have some style factors that went against the way we invest. Value outperformed growth pretty significantly, and low quality businesses outperformed high quality businesses, the types of businesses we prefer. From a sector perspective, I alluded to the fact that energy was really the only positive area of the market. We don't have any weight in that sector, so that was clearly a miss on our part in terms of failing to be able to generate performance through owning energy businesses. And technology, one of our favorite sectors of the market, was the actual worst performer. So we were sort of set up off sides as it relates to the quarter. From a positioning perspective, our portfolio holds 34 companies today. That spans across 7 different sectors, 24 industries, and 11 different countries. We tend to describe the portfolio as balanced, holding position sizes somewhere between 2 and 5% per holding. We're always overweight areas, the classic growth areas of the marketplace. Think of healthcare, industrials, and technology. And currently we have 0 weight in areas like energy, real estate, communication services, as well as utilities. From a regional perspective, over the last 6 or 8 quarters, we have been de-emphasizing emerging markets, specifically taking down exposure to China. Part of that is because of the geopolitical unrest between China and the region, but also partially because the volatility of the market has given us valuations and other opportunities that we find to be attractive. It's very high conviction to get in, high competition to get into this portfolio. U.S. exposure, on the other hand, we've seen an increase, and that's been due to the opportunities we've been seeing in semiconductors, cloud computing, enterprise software, and artificial intelligence related companies, many of which originate out of North America, if not specifically in Silicon Valley. The recent challenging period hasn't really brought forward any aha lessons. It's really reconfirmed the way we approach markets. These volatile periods are typically in the short term, and they hurt. But that's where we do our best work. The investments that we make in volatile periods, when stocks go on sale, when there's blood in the water, or when other investors are fleeing the marketplace, we are there having our work done in advance to be able to upgrade our portfolio and really tend to put positions in the portfolio that will drive the forward 5 and 10-year return stream. We always take a patient long-term view, and that's typically validated as we come out of these volatile periods. Periods like the third quarter really support us owning high-quality growth companies with long-term tailwinds that have expanding moats and supportive cultures. Unprofitable companies or those relying on debt typically get exposed first, and our philosophy and process of avoiding those businesses will hopefully allow us to protect capital in negative markets and give us dry power to be able to allocate into businesses that come to us in terms of cheaper valuations and buying opportunities. Stock that is a good example of an expanding moat with a well-aligned culture that we've added this year is AstraZeneca. This is a pharmaceutical business based in Cambridge, England, that engages in research and development and manufacture of pharmaceutical products. We hadn't had very much pharma-related names in the portfolio in recent years due to a wave of patent cliffs as well as a flood of generics that were hitting the marketplace. From a cultural perspective, we had been paying attention to AstraZeneca in about 2019. They had a cultural shift that focused the company's culture on research and development and away from being a large pharma marketing business. They sell branded drugs across multiple therapeutic classes and have historically been very strong in oncology. There was an acquisition made in 2021 that now gives them a leg up and competitive advantages in rare diseases. So this cultural turnaround now has them positioned in a very advantageous way, because that research and development, which they shine their light on and really turn their focus to, has borne a significant amount of fruit. They currently have a number of blockbuster drugs in the oncology area that not only do not have any competitors, but they will not face patent cliffs for years and years to come. So they now have blockbusters that are able to treat and help folks struggling with lung cancer, breast cancer, pancreatic cancer, and even leukemia. These drugs are viewed as best in class. And again, they don't have any patent cliffs and no competitors in the current market space.